Thanks, Tom. This is Jeff Tjornehoj with the fourth quarter 2015 fixed income funds review. As Tom pointed out, there were tough returns all over the place, and fixed income was no exception. We saw fairly disappointing returns in nearly every sector out there. To give you a little flavor for what went on, these were the total returns for all of our fixed income fund groups. Well, actually, not all of them, the major ones. At the bottom, the one bright picture here was really Muni debt, and we'll get into that a little bit later. But before we do, I'll give you a little flavor for what some of the largest, most visible bond funds did for 2015. So this goes beyond just the fourth quarter, but overall, it was a tough year for fixed income, specifically taxable fixed income. The world's largest bond fund is the Vanguard Total Bond Market Index Fund with about $147 billion behind it. It only eked out a 30 basis point total return for 2015, so not really much to write home about there. What is now the world's third largest bond fund, PIMCO Total Return, with about $90 billion behind it, did manage to outperform the index. It was up about 72 basis points. Not far behind in terms of assets, the MetWest Total Return Bond Fund was down 4 basis points, while the Double Line Total Return Bond Fund was up, and it was a stellar year respectively. It was up about 2.32%. Elsewhere, returns were back to normal. American Funds, Bond Fund of America was up about 24 basis points. T. Rowe Price New Income about 16 basis points to the good. The real disappointment out there this year, poor Dan Fuss watched his Loomis Sales Bond Fund decline 6.86%. So a tough year for Dan and his team. So that gives you a flavor for what investors had to go through this quarter. And as you can see on the slide, it was a tough place to earn any good income in 2015. So where does the U.S. stand relative to the rest of the world? Tom touched on a lot of the factors that are troubling Latin America. Here we have Brazil in particular with a pretty high Fed funds rate, their equivalent of that, which is about 14.25%, but they also have very high inflation. Russia, India, China, all in a similar position. China, of course, much lower inflation rate than any of those, but still at a relatively high interest rate. And yet we still see outflows from China. It was reported this week that an estimated $170 billion of capital was pulled out of China, presumably much of that going to U.S. Treasuries very recently. But too late to save the bond market this year, as we'll see a little bit later on. Treasuries, despite the U.S. having relatively good position in the world economically, we just couldn't find much traction with Treasuries in the fourth quarter. So here's what we saw over the course of the year in the Barclays aggregate, which I don't know if everyone knows this. Will soon be renamed the Bloomberg aggregate, because Bloomberg did buy out the Barclays index service. So we'll be prepared some point this year to change that name. But overall, we saw kind of an up and down, back and forth in the market for the aggregate, with eventually coming in positive, but far below the best point of the year and pretty well above the lowest point of the year. So overall, I think it was a disappointing year. Investors had to suffer through a fairly volatile ride overall if you are an index follower. So it was not an easy way to make a living this year, and consequently, this will probably be remembered as one of the tougher years for fixed income, despite eking out a small gain. It didn't come very easily. So here's the yield curve on U.S. Treasuries over the course of the quarter. The top red line, bolder than the rest, was the year-end view of the yield curve, and then we see quarter end from September, and then a year ago with the gray line. As you can see, there was a lot of movement up in the belly of the curve, really from about the 6-month to about 5 years, maybe about 2 years. We saw interest rates rise significantly. This all has to do with where the Fed was heading with the Fed funds rate. A lot of us, me included, expected some movement of this in September. That didn't happen. And I think the market really forced the Fed's hand in December. They really wanted to see something actionable out of the Fed, because if they kept waiting too long, then they would have to probably force through a number of interest rate increases at some point in either 2016, 2017. The Fed does not want to do that. They don't want to force through a lot of raises when the market's expecting a more gradual, gentle rise. So consequently, December was a make or break time for the Fed. That's what happened, and as you can see, the long end of the curve didn't budge too much, and we'll get into that a little bit later with respect to returns. On a daily basis, over the various tenors, as you can see here, the 30-year, while it was up a little bit, it was, ended up over the 3% mark, just barely, was not nearly as volatile as the yields at the bottom of the curve, especially the 2-year, which is a bit of a proxy for Fed activity. As you can see, it rose from about 60 basis points or so and ended up over 100, close to 102, 103 basis points at the end of December. So kind of a wild ride for short-term treasuries at the very low end of the curve, where we had some negative interest rates from time to time. We clearly got out of that on the 3-month. So in a more logical territory for yields at the very low end of the curve. Now, when we start talking about the returns on the corporate side, it wasn't nearly as expected. Given the soft spot in treasuries, we might have expected that corporates would fare better. They tended to do about as much, maybe slightly better. It depends on where you were on the credit spectrum, with higher quality outperforming lower quality. Again, that lower quality has a lot to do with the circumstances and events that Tom spoke about, with low energy prices and many of the smaller E&P producers in that junk bond territory to begin with, and then you coupled that with falling energy prices, and the market is falling out. The bottom is falling out of the market for those names. So on a total return basis, how do the indexes do for corporate debt? And as you can see, the A eked out a gain at the very end, coming up at the very end of the year, last few weeks of December, with a fairly steady return, enough to coast to a positive quarter. High yield, on the other hand, which started the quarter pretty strongly in spite of what was going on with oil prices, that was also a time where oil was kind of steadying at about 45, 48, and I think the market was trying to catch up with the earlier sell-off. But of course, that buoyancy in oil prices didn't last long, and by the end of October, we're starting to turn over. They worked their way lower through the rest of the year, and I think for the quarter, oil prices were down about 11% or so. This had a lot to do with high yield, even though energy sector is not the largest part of the high yield market. I think it's probably somewhere around 10-12%. It weighed heavily on these factors, and so consequently high yield funds showed some of the worst returns for their indexes. Overall, when we're talking about fund performance for corporate debt, high yield funds were down about 1.90% for the quarter, which led them to a negative 4.1% decline for the year. At the other end of the spectrum, A-rated debt was down about 67 basis points on the quarter, down about 92 basis points for the year, and triple B was slightly worse than A. When we're looking at the spreads, this is where the real story is told. Again, spreads declining on high yield through the beginning of November, and then giving up that ground over the rest of the quarter. While elsewhere, really not a whole lot of movement. Triple B started to ease and widen a bit at the in December, but really not much to write home about. And Triple A on this scale shows very little movement there, where I think it's interesting because people are not giving up on the high quality names in the corporate space, figuring that there's still a very good buy at this point. When it comes to high yield and loan funds, it's good to group them together because they often contain similar sectors, similar names, companies in typically a more strained fiscal condition. Again, high yield growing very well at the beginning of the quarter and then giving it all back through the remaining 2/3 of the quarter. Didn't get that much attention for loan funds. They barely eked out some positive returns at the beginning of the quarter. And again, about the same time that high yield started to turn over, the market pulled out of loan funds. Pat will go into some more detail about the loan fund outflows because they were continuous and unrelenting. And I think because the retail side had very little faith in the loan market, worrying about total returns and so forth. As they kept pulling money out, there was less issuance going on, and consequently, loans were declining in value throughout the quarter. So overall, we saw loan funds with some of the worst returns for the quarter. They were down about 2.1% for the quarter. Overall for the year, though, they were not as bad. They were down about 1.24%. So, for your loan fund investor out there, another difficult year for them. They're losing faith in this asset class as we speak. Next group to talk about, the one that Tom pointed out as having some of the worst performance on the equity side, was also true on the fixed income side. But curiously, hard currency managed to eke out a positive return for the quarter. Same could not be said for its yearly return. So it's kind of an interesting dichotomy here where we actually saw a bit of a divergence in expectations for emerging markets, with the equities declining in value and the fixed income either losing very little or actually making up some ground for the quarter. A lot of this had to do with the direction of the dollar, and this is where the U.S. dollar has gone over the course of the full year, with the shaded area in the fourth quarter, where it was definitely up in the first quarter, treaded water, in second and third, and then again made a move upward in the fourth as oil prices declined, as the Fed raised rates, or at least the expectation was starting to be priced in, and the U.S. looks like a better place as a store of value, at least in the U.S. dollar, and versus other currencies, with the U.S. Federal Reserve starting to tighten policy a little bit. Again, as Tom pointed out, we're only talking a quarter basis point, which gets us to that 0.25, 0.50 range. Still very, very cheap. Not tight at all, but tightening. And this makes the U.S. a pretty good place to park your money. That was attractive. Consequently, the U.S. dollar has ascended in value. This is a trend I think will continue throughout this quarter as well. As far as returns go, as we were talking about, the hard currency eking out a 68 basis point total return, and the local currency losing only 5 basis points. But for the year, hard currency was down about nearly 3%. Emerging market local currency down 13.5%. So still a terrible year for emerging market debt, no matter where you were looking at. As you can see here, versus the index, the JP Morgan EMBI Plus, which actually managed in the fourth quarter to land up about 2%. Fund managers weren't quite that successful. I mean, again, hard currency debt managed to eke out a positive return, but still underperformed its index pretty significantly starting probably about mid-December. A clear divergence there. Local currency never had a chance. It was very volatile. Started off the quarter well. Again, this had to do with oil prices starting to find a bottom at about $45, $48 a barrel. That boded well for local currency debt, but then it all unwound as the quarter progressed. Now the best picture, the best performance, I should say, for the fourth quarter was in municipal debt funds. Investors returned to municipal debt over the summer and really started to solidify their interest in this asset class. Again, Pat will talk about the retail flows and how that made a difference. As far as performance goes, we saw some interesting movement here with respect to yield curves. Now let's start at the bottom here. These are AAA general obligation credits here, and these are the various tenures across, or tenors, I should say, across the bottom. And overall, we saw the yield curve decline, which boded well for municipal debt funds. The AAAs being the highest quality, investors were definitely attracted to them. Curiously enough, Illinois, which certainly is a state that has its share of fiscal problems ahead of it, definitely in Chicago and as well for the entire state when it comes to pension obligations. But Illinois credit actually tightened up pretty well over the quarter. We saw a lot more movement in the yield curve there, relatively speaking, than we did in the AAA. So I think people were starting to get the sense that with maybe a little legislative vigor that Illinois might start to address its problems for the long term. Short term, when we're looking at the curve here, it's still well above by 200 basis points, AAAs. So I don't think anyone's fooled that anything's going to happen anytime soon. They're just a little more positive. And again, lower oil prices might help some of the muni credits in Illinois as well. Now, while most mutual funds are swearing off Puerto Rico, there are still some firms out there, such as Oppenheimer and a few others, Franklin, that continue to keep Puerto Rican paper in their municipal debt funds. This is the shape of the curve over the course of the quarter. As you can see, it looked a little funky at the end of Q3 with that sudden spike from 2016 to 2017. That tended to flatten out a little bit, but go a little bit higher and extend out to about 2020 paper over the course of this quarter. I think the expectation here is that there's a lot of volatility ahead for Puerto Rico as it tries to get its finances under control. Long term, people have a more optimistic view, still, 600 basis points or so over AAA paper. No one's under the impression that Puerto Rico is anywhere close to out of a desperate situation. But the thing to keep in mind here, and what I want to point out at the start of the year, it's my theory that Puerto Rico, while, as I said before, is of a limited scope within most mutual funds, will represent a significant headline risk in 2016 for municipal paper. I think we need to be cautious about this. This might have its, what we might call the, what was her name, the Whitney, Meredith Whitney, might have its Meredith Whitney moment in 2016, where it's really a headline risk that is overexposed by the media, and that may cause investors to question municipal debt funds at a time when probably municipal debt is relatively stronger than any other place. So it's one thing that I would hope that investors understand is the context around Puerto Rico. Desperate situation, not necessarily all that important to most municipal debt funds. And finally, for my own concerns and forecast, I do believe that China's problems are not near the finish line. As Tom pointed out, the first couple of days triggered the circuit breakers, and that has been addressed by Chinese regulators. They dropped the circuit breakers entirely, presumably because they understood that they weren't enforcing them very well. The Fed is going to get a lot of attention in the months ahead. They're going to have their next meeting in March. I don't know what the Fed futures market is forecasting right now as far as raising rates in March. Personally, I doubt it. I don't think we'll see more than 2 raises over the course of this year out of 6 or so opportunities. I don't think they're going to raise nearly as quickly. I think they still want to maintain a very accommodative, dovish position, and they're going to take a very measured response to economic conditions in the U.S. as well as abroad. We're not going to forget what China's going through, and as Tom pointed out, we're not likely to import China's problems, but they will have an effect on the market as they change the conditions for U.S. companies that do a lot of business in China, as well as countries that do a lot of business with China. So it will have a global effect. Hopefully the U.S. has a bit of insulation from that, but it's definitely going to be of some concern. My forecast for the year ahead, There's going to be more easing in Europe and Japan. Europe, I think, so far has disappointed in the amount of easing that they've done. So I think that continues to make the U.S. attractive. Definitely, we saw a soft market for Treasury and government debt in the fourth quarter. I think that'll change over the course of the next quarter or two. I think elsewhere, mortgages are in a really good spot. They saw fairly decent returns in the fourth quarter. Ginnie Mae funds were only down about 14 basis points and ended the year up about 65. So I think while that's not much to crow about as far as momentum, I think that it does indicate a fairly supportive market for mortgages right now. I think investment grade will continue to outperform high yield, as well munis will be in the catbird seat over the course of this year, as I think they'll continue to outperform in the quarters ahead. So with that, I would like to turn it over to Pat Keown.